on January 29th at 9:02 a.m. Let's see. So investment updates. And so we're going to start with Cargill Falls. And that would be, I think Mariana is going to talk to us about Cargill Falls.
That's right, Lonnie. Thank you.
Yeah.
Good morning, everybody. This is Mariana Treat. This will be really quickly, but we came back to the board in December and said we would be coming in January with a loan restructure. However, even though the 2025 budget has been completed, which is the basis for a multi-year projection, there's still some ongoing discussions with some of the key stakeholders, primarily Enhanced Capital and Haynes Construction, which both have deferred payments for Enhanced and an outstanding loan balance for Haynes Construction. And therefore, until those are sort of resolved or further advanced, we are asking the board for an additional deferral of our payment for the next period until July 2025, so that we can continue to have those discussions that will allow us to bring forward a comprehensive loan restructuring proposal. So we plan to do that later in 2025. And as part of doing that, what our goal continues to be with our CPACE loan is to maintain the first lien security while sort of aligning the goals of the property and other stakeholders. So I'll leave it at that. And if you go to the next slide, you'll see the board resolutions, which basically indicate approval from the loan to, again, I don't know if somebody can hit the next slide. No, thank you. Defer payments until July 1st, 2025, consistent with the board memo that we've presented.
Does anybody have any questions? Okay.
Yeah,
Oh, go ahead.
Yeah, hey, it's Tom. Okay, so forgive me. Just give me a little background here. Is this the first time they've asked for a deferral?
No, this has been a project that we've had to defer now for about 2 years. Cargill Falls is a large mixed-use redevelopment of both residential and commercial. A portion of the residential units, I want to say about 40%, or at least 40%, is designated for low income. And they have had a big issue that was identified probably 2 years ago with lead in the building that required remediation of most of the building. The first requirements for lead remediation were sort of paid out of cash flow from the property, and that was associated with our first loan deferral. And then the second portion of the deeper remediation, which came from an EPA order, required the property to go back to DOH, and DOH provided funding to the tune of about $600,000 for the remediation of the property. So therefore, the property's undergone sort of challenges and vacancies associated with that remediation. Remediation was completed as of October of last year, and the property is sort of close to stabilization. We did a more comprehensive update in December about sort of how vacancies have reduced. They're at over 90% capacity now, and the property is getting stabilized, which is why we were anticipating being able to present a loan restructure at the January board meeting, but we've had some discussions with some of the other stakeholders that need to be sort of ironed out before we bring this proposal to you all.
So, and I did remember a bunch of that, but not all of it. So thank you. Question here: the conversations with the stakeholders, what are those largely about? Our place in line? I'm trying to assess our actual risk here. And I'd also like to know, to the accounting team, how is this represented on our balance sheet? Are we reserved on this, or what's going on here?
So this is, Tom, the principal outstanding on this loan is about 10.8 million. That includes deferrals of payments that haven't been made over the last two-ish years. We have a CPACE security on the property, so we're sort of, as I'm not going to say as protected as can be, but we're first lien on the property. There is also a mortgage from Haynes Construction because there was sort of a gap of funding when the property was redeveloped. And there's around 500,000 outstanding on that loan. So they have a mortgage on the property, but as a CPACE lien, we sort of have priority over them. The other key stakeholder is Enhanced Capital, who provided tax credits, federal tax credits, there were state historic tax credit, and they were the tax credit partner. And they have an ownership in the property and deferred payments associated with that sort of operating agreement. But from a security perspective, the CPACE lien comes first. I don't want to get into too many details here just because this is public. I'd be happy to have a side conversation with you, but there's sort of some misalignment between the payments of the other stakeholders, not necessarily green banks, and there's no question about our position.
Yeah, because what concerned me was the commentary that, oh, there's ongoing discussions with other people, because at the end of the day, we should come first and we should not be looking at anything other than that. Terribly sorry, but that's where we need to be, particularly dealing with, public funds. And that was the whole basis of CPACE, right? Was we come
Mary,
first.
Mariana, if I could just jump in. Tom, there's no question about that. We've personally had discussions with the stakeholders, and that point is absolutely understood.
Okay.
We're first.
What's the value of their property? I mean, Bert, what I'm getting at is, we've got 10 million outstanding, right? How much is that at risk, and do we reserve against any of that at this point? Because this is a number of deferrals in a couple of years down the road, right?
Yeah. So the project is a split between, say, the typical CPACE portion for retrofits, or actually new construction, um, uh, effectively gut rehab, since this was an old mill. So we provided financing against several pieces of the equipment, in addition to where we started from was providing financing for the hydroelectric portion of the project. So if you will, there are two portions of the project. There's that hydroelectric side, and then there's the retrofit side of the project. So my personal view is that if you look at the two pieces, we're in a fine position to recover our investment. That means, because that extends over a 35-year period, which has been presented to the board in the past. But at the same time, the Green Bank has substantial reserves on our books. I believe the figure is to the tune of about 7% of our overall investments. Which is multiples, as you know, of what a typical financial institution will carry. So I think that we're well covered in terms of our reserves, any reserves we would need for this particular property. The property is a fine property. I think the issue is that we would if we had to turn this property in a sale, we would be fine. I would dare say that equity at the current point would be hard pressed to get anything out of it. And that's why we're trying to make sure that we get the property properly stabilized, working with the property management. As Mariana pointed out, there units had to be vacated for the remediation work and so forth. So you can't get a clear line of revenue that is consistent until we get everybody back into the apartments, and not we, but the property manager gets everybody back into the apartments. So we get a stable and sustained cash flow for, I would say, a period of 24 months, so that you can have a look back period where everybody says, okay, property stabilized, everything's fine, all the issues have been addressed. So then it would be the time, we think, to take a look at, what are the options? What are the options for the owners? What are the options for us, quite frankly?
So it sounds like we don't have a specific reserve against this, but you believe that the general reserves are enough to cover it. And the concern right now is the fact that the building largely has been offline during this period to deal with these issues. So you don't have a view on, what a normalized cash flow would be to pay us back. But you're also representing that the appraisal of the building would indicate that our $10 million would be covered by any proceeds of the sale, but that others involved in this business, in this building, might lose money relative to that. Is that a fair summary, Bert?
That's absolutely right. There are, and Mariana confirmed this if I'm incorrect, but you have the people who have they're looking to get money out of this, in addition to ourselves, would be, as she mentioned, Haynes Construction. You have enhanced with the state historic tax credits. You have the owner, a woman entrepreneur, real estate investor. You have the Department of Housing. So yeah, you have all of those parties that are vying to get something out of this property. So, but again, we are first.
And there's no intention during negotiations or anything to change our position as it regards our place in line, obviously, right?
Absolutely not.
Yeah. Okay. Thank you, guys.
You
Thank
bet.
you, Madam Chairwoman.
Thank you. And before all of the lead and all of that, I mean, people were flocking to live in that building, right? I mean, and in fact, it's 90%.
Yeah.
Even now,
So
even now with all of the bad
so it was
moments, it's still 90%.
It was at about 50% vacancy during the lead remediation, and part of that is because they weren't signing on new folks until the lead was completed. It was harder to manage a remediation with tenants in the building because you actually had to relocate them. But once the remediation was completed, which again was in October, lease up started again. And as of a week ago, it was 90% leased up. So there's no issue there from a lease up. There's demand. There's a wait list.
Yeah,
So it really, the remediation needed to happen and to get completed for the project to get stabilized. And I will just add that the hydro, which is a component of the project, is bringing in about over $500,000 in revenue from both energy savings and excess sales, in addition to ZREC revenue. So that's been an important factor or contributor to the sort of the health of the property.
great. Any more questions? Do I hear a motion?
Madam Chair, I just have to say it reminds me of the paraphrase, The Princess Bride: never get involved in a land war in Asia, and be careful of mixed-use buildings with hydro.
That's an old saying?
It's from The Princess Bride. So, but I make a motion to move the resolution.
Thank you, John. Do you hear a second?
Second.
That was
Matt.
Tom?
Matt.
Matt. Oh, thank you, Matt.
That was Matt.
Oh, good. Thank you. Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Okay, thank you. All right. moving on to item number 2, Posigen, facility modification. So I think Bert and Larry are going to talk about that, right? Bert, you want to?
Actually, I'm going to hand it over to Larry. Larry's got this one. Thank you.
Sure
Hi,
thing.
Larry.
Thank you, Chair Reed. Thank you, Bert. We have had a fairly predictable cadence with Posigen over the last couple of years with modifications to the facility, while and this is similar to past modifications where our position is not financially changing, but the position around us is changing, and I'll talk a little bit about that. But the reason for this modification request, actually 2 modification requests, is that Posigen has continued to grow, and they continue to require more debt to fund that growth. They have installed 6,300 residential systems in Connecticut, and 15% of their workforce lives in Connecticut, which is 100 people. So they've continued to meet to exceed expectations that we've had for them through our partnership. They have secured additional capital for growth. So this is the second upsize, happened in October. And they're now up to $600 million in their first lien credit facility, and that happened in October, and we're asking for approval for that, as well as for an upsize in the second lien credit facility. The second lien credit facility is the facility that we are invested in. It's currently at $34 million, and Posigen would like to accept another $6 million into that facility for a total of $40 million. So with the first lien credit facility and with the second lien credit facility, no additional capital is being funded from the Connecticut Green Bank. This is through either impact assets or an alternate if the deal doesn't go through with them. But with both of them, we are not providing any additional capital, so our facility remains unchanged. Is there one additional slide? Or is it go right to the resolution? You can go to the next slide regardless. So what we're asking the board for is to ratify the decision for our support in October to approve the change up to $600 million in the first lien credit facility. And we are also asking the board for permission for us to approve the change in the second lien credit facility up to $40 million. The points of this are that we are not putting any additional investment out the door, and that this is all due to positive momentum with Posigen as they continue to grow and require capital to install solar facilities within our state and throughout the nation. So that's everything. And I turn it over to the group for any questions and ask for your approval of this resolution.
Any questions? Tom? Matt?
Yeah, hey, Larry, I thank you, Madam Chair. Yeah, I do have a question. The last thing you said caught my ear. Our funds are they restricted, the portion we're providing, which apparently is nothing new, for use in Connecticut? Because as you mentioned, Posigen has a larger platform. Not that I personally would mind. I know we've talked about that, but just in terms of auditors and things like that, are funds being applied in Connecticut or being utilized elsewhere?
I would, yeah, go ahead, Bert.
Larry, I'll take that. Matt, you might recall that when we started out with the You might recall because you've been here for the entire ride of the Green Bank. That's why I said it
Yeah.
that way.
No.
But back in 2015, when we established the first facility with Posigen, and we were the first money in, it was a $5 million facility, $5 million facility, expanding up to 10 million if they were successful, and we're both successful in bringing in additional participants, which we were over time. Those facilities were constrained specifically to Connecticut, as they attracted substantially more capital and moved into additional states. They were in Florida, they were in New York, they were in Rhode Island with a Solar for All campaign there, and such. It became necessary as we presented to the board to take a position of our financing as a percentage of a pool of assets is well represented. So we're not exceeding that threshold, meaning there are more Connecticut assets as a percentage of the pool than our funding against the pool represents. This is an increasing trend for all green banks, meaning that particularly green banks with from states of our size, meaning that it would be incomprehensibly complex to start to pull out pieces of the collateral pool and assign it to this
Yeah.
particular lender, that particular lender. So yeah, we presented
But
to the board, and the board agreed to take a holistic view on that.
Right. So, but the Connecticut assets exceed the amount of our commitment is the sort of the bottom line.
Is the bottom line, yes.
Okay, that's fine. And nothing in this resolution changes the way we've accounted for that. And it's not
No,
been an issue.
not at all.
That's great. I mean, they've done great work. I was just more thinking of our, auditors of public accounts, whether this would be a change, but it sounds like the same way we've handled it throughout, or
Yes.
since they expanded their playing field. Yeah.
Correct. Mm-hmm.
Yeah, just because I don't want to disappoint the chairwoman, I have one question. How's that?
Let us have it. Let us have it.
Look, I know they've done good work. I've followed what we've done with this. My question would just be, do we have any concern about concentration of risk with one entity?
Tom, we do not, and the reason is because as you may know, we've got considerable experience in terms of residential loan portfolios. In fact, that
Yep.
was the reason why we felt comfortable going back to 2015, providing the initial facility to Posigen. So there are 20,000 plus systems with all generating cash flow behind this. So think of it, if you will, as like a private credit securitization. So it's well diversified. Also, they are putting themselves in position for ultimately going toward a securitization type of approach, but they're looking at a couple of options that they're probably still a couple of years off from something like that. But they're getting they have all their systems and mechanisms in place. So we have confidence that they've got everything set up right. And if they should falter, then we would look with the other lenders to step in and make sure that everything's being collected properly and serviced properly. There are backup servicing arrangements that can be put in place pretty quickly.
Bert, what's of our portfolio in this area? Like, what percentage would this represent, though? I guess. I know what you're saying about them being a good risk. I just want to know what concentration we have.
I'm sorry. want to make sure I've got your question because I kind of I was thinking it was one way, then it seemed to go in a different direction. Could you repeat it, please?
What I'm trying to figure out is how much money are we committing to have available for them as compared to the overall amount of money we have available in this type of investment. Does that make sense? It's
Sure.
it's
So
it's all about it's just all
so
about, you know, the concentration of the risk. That's it. I know you believe it's a good credit, and
yeah,
I agree. You know, I don't have any reason to disavow that. I just want to know, you know, what percentage of our assets should they utilize them all? Would that end? Would that become? Does that
right.
make sense?
Yeah. So if you look, there are two portions of this as far as our exposure is concerned. We're secured by a lease revenue stream in this second lien credit facility, all right, as well as our own performance-based incentives under the RCIP. So that that represents about the PBI portion, the performance-based incentive portion, is a sweep of cash, everything that we pay against their assets that are performing in Connecticut. They get that incentive. They're supposed to get that incentive, but what we do is we take that 100%. That's defeased and swept. So that's about $6.5 million right there. The balance, which is about $17 million, is the lease stream. So we consider the defeased portion, because we're paying that off directly from the cash flows that we would have given them anyway, as kind of locked out. So if you look at the 17 million, it's less than 10% of our investments at June 30th of 24, which I think Jane quoted yesterday in our conversations with the Connecticut Treasurer's Office at being $191 million. So
So you're
we're
saying
inside
we're
10%.
so in short, you're saying the concentration risk is $10 million on 190 million, so somewhere under
17 on
17,
100.
so under
Yeah.
10%.
Yes. And also bear in mind that there are, again, as I mentioned in the last discussion, with our facility at not Colebrook, in Putnam, that we have 7% of our portfolio, 7% of that $191 million in reserves. So against that
Yeah, you
portfolio,
mentioned
entire
that, or
portfolio.
yeah, yeah, no, you mentioned that earlier. What I'd like to do, Madam Chairwoman, at some point is maybe discuss with just management of the Green Bank, if there's not one in place, which I might just be unaware, kind of a cap on how much we can commit to um, one entity as compared to our portfolio as a whole, so that we don't have a concentration risk issue.
I mean, a percentage, based on a percentage.
Yeah, and mind you, just to put this in context, I come from the town of Fairfield, and they invested too much of their funds in it with a gentleman named Bernie Madoff. And it took down our pension funds from being overvalued at about 115% to being undervalued to about 80%. Right now, I wasn't involved in that, but came in after the fact. And, it was a lesson learned that we should, be careful in terms of where we concentrate our investments and our funds. That's all, on a percentage basis. That would be, I mean, that's obviously open for board discussion. That's just my bias. So,
Yeah, I think it's a good point, Tom. Again, I bring the board back to the fact that there are north of 20,000 projects that
right.
are all cash flowing. So that's we take comfort in that. And
I get it.
also,
I do. And
and
thanks
also,
for your answer, Bert, by
yeah.
the way.
Okay. Yep, you bet.
Okay, any more questions?
Lana, just a quick comment on Tom's, maybe Bert, when you're having that discussion, it might be useful to look back and see what our concentrations have been. I think there was a time where, I can't remember who it was, but it was one of the Elon Musk companies that was a big part of our portfolio. and maybe look back at, what our experience was there when they pulled out of Connecticut to help guide what the limit might be.
Okay, we'll have that conversation.
Yeah, no,
Yeah.
that sounds like a conversation we all need to have going forward.
Yeah, I can't remember. It wasn't Sunrun. It was whatever I'm drawing a blank on the company name.
Solar City.
Solar City.
Solar State. Oh, that's
Yeah,
right.
but
That's right.
we never had any facility outstanding with Solar City though.
Okay. All right. I thought maybe I'm mixing them up. We had. All right. Anyway, I don't want to delay everybody. Let's keep moving.
Okay. So, do I hear a motion to approve Resolution 2?
So
moved,
moved.
John.
Okay.
Well, second, John Hardy.
Okay, a motion and a second. All in favor?
Aye.
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 Opposed? Abstaining? Okie dokie. Moving on. This is our Smarty Loan Program. So this is our next item. Has been seeking to attract additional capital providers and for Connecticut homeowners, and an existing partner, SunGage, has stepped forward with what's an innovative approach. So we're going to have, I think, Bert, Fiona, and Larry are going to tell us about this.
Yes, it'll be Bert and Larry. Fiona, unfortunately, is ill today. So we have, yeah, as you mentioned, the Smarty Loan Program it's our total energy solution, loan energy solution for anything that a homeowner wants to do as far as retrofits, putting in heat pumps, putting in solar, battery storage, and more recently, projects that enhance the resilience of the property. All of these uses has caused a bit of a strain on our lenders' ability to catch up. And what we've been doing, this is particularly in light of the fact that Capital for Change has paused their participation in the program for more than a year now, and it's unclear if they will rejoin the program. They're servicing their portfolio now, but whether they will take on additional Smart E transactions in the future is not clear. So we've been talking to additional financial institutions in the state, and then we opened up a conversation with SunGage as they we became aware that they were talking to Posigen actually about a possible program in financing. So this is how this conversation kind of originated. And as we talked to them about the challenge that we were having in the market, particularly with solar and storage, because those projects are very high dollar value. They came up with a concept that would blend our Greenbank capital, if we could keep the rate that we put it into the pool and at a lower level, much like we're doing under a linked deposits program that the board previously approved. Then combined with that, they would be able to put into the market a competitively priced product and lend to homeowners for up to 25 years on such attractive terms. Also, they would be able to provide an investment tax credit bridge loan product. How that works is that the customer who buys a system is entitled to investment tax credit, but that investment tax credit doesn't come in until the customer files their federal tax return. So Capital for Change had been providing such a bridge loan product to kind of bridge that gap for when the cash would finally come in for the homeowner. But as they have now paused, that created another challenge. So this is the opportunity that's been presented by SunGage. And Larry, I'll turn it over to you to go through the details.
Terrific. So we can go to the next slide. So as Bert said, there was a need for us to add an additional Smart E lender to our portfolio to fill the gap that was left, and in particular for larger projects, which, as Bert said, are more solar and storage. That's SunGage's focus. So that is a great fit. Another great fit is the fact that SunGage and Connecticut Green Bank have had a long working relationship together since 2013. It was I think the first solar loan before my time, but suffice to say that we've had a long, successful working relationship with SunGage, and so that's another positive attribute of working with SunGage again to fill this need. And then another is the fact that SunGage is a significantly sized lender, and they also are eager to expand their Connecticut footprint. They operate here and lend here, but would like a higher volume within our state, and they need something to catalyze that. So we have a need, they have a need. It really is. I won't say the perfect match, but a very good beginning to our relationship. So the need is for what we hope to catalyze their increased volume is to use the rates that we offer through Smart E. As Bert said, that they're really not, they really weren't able to meet these rates due to their own business model. But with some creative financing, we have come up with an agreement where Connecticut Green Bank will lend to them, and then they will in turn issue loans to the end users in Connecticut. And since we have a lower cost of capital, which we've kind of blacked out here because that's kind of their secret sauce, but suffice to say that the loan that we are recommending to the board today for $10 million will allow SunGage to meet the rates of the Smart E program. So we're asking the board for two things today. Number one is to approve SunGage as a Smart E lender to offer loans through the program to end users in Connecticut. The second is for the Connecticut Green Bank to offer a $10 million loan at 4%, secured by the portfolio, which will ultimately allow SunGage to offer the Smart E rates to the end users. So it's two things. It's the debt, and it's also their participation in the program.
Yep. To be clear, there's the advances will be against a pool of loans. It's not the SunGage themselves. It's against a pool of loans. So it's much like the POSIGEN structure, if you will, where they're special purpose entities, and so you've got the collateral, which are the loans to the homeowners locked up in a secure manner. So this is not, we're not putting 10 million out the doors on day one. It will be advanced over time as the homeowner advances are made. I just wanted to be clear on that.
Do I hear any questions?
I do have a question on that last point, Bert, that you just made. That pool of loans is similar to the question that was asked the other programs. That pool of loans is a Connecticut pool only, or is it diversified geographically?
In this case, it's a Connecticut pool.
Any more questions or concerns? Do I hear a motion to approve Resolution 3?
I'll make that motion.
Second.
Thank you. Thank you. Okay, all in favor?
Aye.
Opposed? Abstaining? All righty. Let's see, the next item is, well, I think we're going to hear, it's about scale microgrids. And we're going to hear from
That would be David
Bert.
Beach.
Oh, and Dave. Okay. David Beach.
Thank you, Jerry. I'm presenting to the board a proposal for the Green Bank to participate in credit facilities for a portfolio of community solar, battery storage, and microgrid assets that's being developed by Scale Microgrids. We've worked with Scale Microgrids a couple times in the past, including this past summer when we worked with them to provide similar credit facilities for a fuel cell and thermal loop project in Bridgeport. So this portfolio, like I said, it's 33 projects split up between community solar, battery storage, and other microgrid assets. 8 of those 33 projects are located in Connecticut, and all 8 of those are battery energy storage projects that will be participating in the Green Bank's Energy Storage Solutions Program. The Connecticut projects represent about 33 megawatts and $55 million of project costs. Both of those make up over 15% of the portfolio. One other thing to note here, in connecting with my colleagues on the Energy Storage Solutions Program, I can share that these 8 projects in Connecticut are expected to reduce peak demand by up to 27 megawatts for the 10 years that they'll be in the program. So that's exciting. We can go to the next slide, and I'll talk a little bit about the structure of these credit facilities that are proposed. Great. So KeyBank, they have an investment banking arm, and there's also an actual bank arm. Their investment banking arm is working with Scale to structure these credit facilities, and then their bank will actually be one of the lenders. We are seeking approval for the Green Bank to participate in these credit facilities at an amount not to exceed $10 million over the different facilities. The construction facilities are made up of a $125 million construction loan and a tax equity bridge loan of about $140 million. Together, those construction loans will represent up to 89% of the portfolio project costs, and that aligns with the minimum equity requirement from Scale Microgrids, which is at least 10%. When construction is complete, the tax equity bridge loan will be retired by the tax equity contributions made by the tax equity investor. Scale has already secured a facility or a commitment from Truist Bank to act as the tax equity provider here. And at the same time, when the projects reach commercial operations, the construction loan will convert to a term loan that is sized to be $118 million. Down there below, you can see a chart that just shows these sources and uses during construction. And if we can go to the next slide, I'll just talk a little bit about some of the risks and mitigants. This isn't a full list, but some of the ones I want to highlight. So in terms of development and siting risk, Scale has site control for all the community solar and battery only projects. So that includes all 8 projects in Connecticut. For the microgrid projects, Scale gets site control when when a customer signs a microgrid service agreement. And so there's 4 of those remaining to be signed, but Scale expects they're working through that process and expects them all to be signed in the first half of 2025. In terms of production risk for the portfolio, an independent engineer, Black & Veatch, has reviewed and provided a report giving some credence to the production estimates that have been provided. Additionally, production risk is mitigated by the fact that we have 33 projects in a portfolio that diversifies and helps with some of that potential concentration. And there's also a 6-month debt service reserve that offers a sort of cushion if there ever does happen to be a situation where one of the assets or a couple assets have to be taken offline. In terms of credit risk, a majority of the off-takers for these projects are investment grade. However, there are some that are not. So to mitigate the risk, a couple of things have happened. One, the lenders have structured the credit facilities to increase the debt service coverage ratio applied to any expected revenue streams that are coming from an off-taker that's not investment grade. And then also Scale has gone out and actually purchased credit insurance to cover that risk. So the credit insurance, Scale secured that for 10 years. And that policy covers the default risk for payments made by, like I said, these non-investment grade rated off-takers. And when they are covered by this credit insurance, they are then essentially deemed credit or investment grade equivalent by the lenders. And to ensure that Scale is able to, and Scale or the lenders are able to utilize that policy, Scale is required to maintain an insurance reserve that covers the deductible throughout the 10 years. That has been essentially my presentation overview of these credit facilities. I will pause and hand it back to you, Chair Reed, for any questions.
Thank you. Do we have any questions? Matt, Tom, John, Adrian?
Let me just ask, does all this activity indicate that things are going well or that there's problems in the market?
I take Scale as a strong portfolio as positive indications. I can tell you they are making and have significant plans to make sure they are starting construction and safe harboring these projects within 2025 or as soon as possible to ensure they're locking in their tax credits at the current state. But I mean, I'm not able to necessarily extrapolate from this portfolio, but it's certainly a good sign for Scale that they are continuing to grow and have such a strong pipeline of projects.
It's certainly good news for the ESS program in our state.
Any more questions or concerns?
With all these, following up on that, oh, I'm sorry, Adrian, go ahead.
Yeah, Adrienne?
No, oh, sorry, hold on. I'm not sure my sound is up. Okay. I just wanted to say I'm really excited about this because I guess we will be the first of the guinea pigs, right? And is this related to the New Power project?
So Scale Microgrids is also the owner of that project. They purchased it and they are doing construction. That project is kind of standalone and we're participating in the kind of similarly structured credit facilities for that project. But the connection just stops there. It's just the same owner.
Okay. With Bert, we talked about the possibility of having a SEBA with the local NRZ in the south end of Bridgeport, because you guys are going to be paid interest rate, that you thought maybe you could hive off a few cents on the dollar to go to the NRZ for community projects or whatever they thought an investment in the community might be. So all of this is going to give us things to think about and to kind of pave the road for how we do SEBAs of this nature. It's uncharted territory in our geographical district, but I think it will be really worthwhile to buckle down and look at what some of those provisions might be and with whom. Who has to be around the table to discuss any kind of a SEBA. I can't imagine that we would only have the NRZ involved because we've got the city behind that, and we also have a number of community-based organizations who probably should be involved in such discussions. So it's a beginning. Nice job.
I see Matt has a question.
Yeah.
Hope you put yourself on mute, Matt.
Oh, thank you. It was just on the construction loans. Are the loans like? Do we, before we put the money out the door, will we get some confirmation that they've safe harbored the project? In other words, before disbursement of some or all of the loan?
Yeah, we will get that, and essentially it comes from the fact that there's a 10% minimum equity requirement from scale, and that applies to every project, not just the portfolio. So that means that 10% of the project costs have to already be spent, which in I think pretty much every scenario will kind of ensure safe harbor for a project. But we will also get that.
We'll get confirmation of that.
Yeah.
Sort of as, okay, great.
Any more questions? Do I hear a motion to approve Resolution 4?
This is Matt, so moved.
Thank you. Do I hear a second?
Second, Adrian.
Thank you, Adrian. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay, thank you. Okay, moving on to our next item. This is a request from DEEP that the board approves, let's see, the Green Bank entering into a contract to administer an energy efficiency revolving loan fund awarded by the Department of Energy, which I assume made it through the night. We still have a Department of Energy, yes. In our funds, or there was a limit on freezing them for at the end of the day yesterday. So Sarah, I think Sarah Harari is going to talk to us about this.
Thank you, Chair Reid. So yeah, as you alluded to, 2 years ago, the Department of Energy announced the Energy Efficiency Revolving Loan Fund Capitalization Grant Program. This was a formula grant program that allocated money to states based on population to support energy efficiency loans. DEEP, who's the lead recipient of these formula funds, engaged the Green Bank to draft a proposal that was accepted by DOE late last year. We have proposed deploying these funds into the multifamily affordable housing energy efficiency projects. And we come to the board today to seek approval to enter into a contract with DEEP to receive these funds, approximately $1.2 million. We are still in the process of scoping the method that will apply these funds, but are considering initiating an interest rate buy down on our Lime loan programs, which are offered by Capital for Change, using the loans to fund energy efficiency improvements required by the tenant sharing revenue rules of affordable multifamily solar projects, and or buy downs of the Green Bank's rate of return for affordable multifamily solar and storage leases. So we'll be working closely with the DEEP BETP team as we move towards implementing these funds, but require approval from the board to enter into that contract with DEEP to receive the funds. So short and sweet for me.
And you've been working really well with DEEP, right?
Yeah, we've been working on a lot of different projects. The school bus one that I came to you with last week and last month, and now this program as well. It's been great to collaborate with Joe and his team.
Great. Okay. Do we hear any questions? Concerns? Do I hear a motion to approve Resolution 5?
This is Dominic, so moved.
This is
Oh, thank Dominic. Do we hear a second?
This is Matt, second.
Thank you, Matt. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay, thank you, everybody.
Madam Chair,
Yes.
just in case we happen to run out of time, I'm going to recommend that we go to the ESS energy storage solution, the next one.
Oh, okay.
Because we could bring this Webster matter to deployment. It's 500,000.
Thank you, Bert.
Thanks.
Thank you, Madam
All right.
Chair.
So this will be so Sergio and Ed.
Yes. Can you hear me okay?
Yeah, go ahead.
Okay. Thank you. So this project, this is an ESS project, ESS 1039 for Danbury Mission Technologies, brought to us by CPower. Danbury Mission Technologies is part of the ARCA group, which develops high precision optics for ground, air, and space missions based in Danbury. They have about 500 employees, and they're a NASA and defense contractor. And noteworthy, they developed the optics system for the Hubble Space Telescope and some Cold War era satellites. So it's pretty neat business. This is for a Tesla Megapack system. The business, their annual peak demand is extremely high. at about 3,500 kW. The system is sized at about 5 megawatts, 10 megawatt hours, which is going to be split between two of the 2-hour Tesla Megapack 2 XL and one of the smaller Tesla Megapacks. We expect C-Power to, well, they've already submitted their interconnection application. They've already gone into their distribution study process with Eversource. And we expect the timeline to be somewhere for installation between 2027 and 2028, given the large size and the fact that it will need to go to ISO New England for a transmission study. Total installed cost is about $3.9 million estimated right now. And the upfront incentive that we're seeking is $905,996. Which was calculated just straightforward using the program calculator at the current rates that just launched on December 4th. So on to the resolution here, I'm sorry, are there any questions before?
Just in 25 words or less, what is a Tesla Megapack?
It is, it's about the size of a shipping container. And it's just a large container full of batteries and inverters and cooling and other materials. So it's designed to be a battery storage system that's all in one that can be dropped on a concrete pad.
Thank you.
Any more questions? Do I hear a motion to approve Resolution 7?
I'll make that motion. It's Joe.
Thank you. Do we hear a second?
Second. Tom.
Oh, thanks, Tom. Okay, all in favor?
Aye.
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 Opposed?
Aye.
Aye.
Walking me around yesterday, I did 100 steps. So, which I was very.
Well, that's good to know.
Okay, we're applauding.
Hey, guys, unfortunately, I have to drop. It's 10 o'clock and I have a conflict.
Okay, do we still have a quorum?
I
don't
think
know. I
we're
know Matt had to drop
losing
too.
Matt as well. So,
Yeah.
but I think our last one is the USDA. So so we can push that to deployment or the special board meeting that we have lined up. One of those two, we'll put it in there. So no
Okay.
worries. We
Okay.
got
Thank
the
you,
big
guys.
ones we needed to get done. Thank you to the
Thanks,
board.
everybody. And
Have a
we
great
asked,
day.
and we went deep. We asked good questions, so that was good. We didn't just
Yeah.
rubber stamp.
There you
Um,
go. Thank you.
Thank you. Thanks, everybody. So
Thanks
do I
all.
hear a motion to adjourn?
So moved.
Second,
Second.
all in favor? Yes.
Aye.
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 Okay.
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 Thanks,
Aye.
everybody.
Thanks,
Bye-bye.
everybody.
Bye.
Bye-bye.